I'm delighted to be joined by Omar Najia, Global Head of Derivatives at BB Energy, Peter McGuire, CEO of XM Australia, and Jamie Ingram, Senior Editor at MEIS. Great. Good morning to you gentlemen again. Happy Monday. We're nearly finished with November. Peter, on that point of risk on for oil is cheap at the moment compared to other commodities, other goods, etc. That argument, inflation. But what about, sort of evidence from China as we go forward into 2024? Does that matter anymore? Oil is cheap today, so is the only way up, is what I'm asking you, regardless of what we see happening in two or three of the biggest consumers in the world, US, OECD, or China?
Yeah, sure, Dyala. Greetings from Sydney. It's wiped out 50 cents since this morning, so that's given us some indication. Also, you've had a weakening US dollar. So they're really in tandem. As the US dollar's been sucked down, so has oil. So it's a double whammy. And that needs to be all, if you're getting paid in US dollars, then that's not a good sign. Also, you be mindful, gold's really had a nice uptick. It's now at $2,030. So, there's another mindset there as well. As far as how we look next year, well, we all understand Chinese exports. They were well down. We're looking at global exports are very weak. You look at German PMIs. There's no growth anywhere that's really outstanding, Dyala. I don't see any. So that's a real, I think, mindset that we're going to wrap our heads around as far as 24 and consumption. And if it's as bad as what it's, turning into, or I'm not saying manifesting, but if it's turning into, it's going to be a tough 24, then let's just see, where the oil market goes. It needs to, I think, obviously, they're going to see big cuts from OPEC, maybe not this week, but you will over the next matter of months. They want their price higher. And I think there's going to be a little of argy-bargy between all players.
Peter, talking about gas and China, sticking with China, we have one of the headlines this morning about China gas demand is going to be increasing, and especially taking its raw gas from Gazprom. Is that a positive sign, or is that just regular cyclical seasonal demand? What should we look into that?
I think it's both. I think it's both, Dyala. I think it's cyclical naturally. And I think that you've just got that, I suppose, the inbound or the domestic consumption seems to be fairly strong. The economy is bubbling along. They're conscious as far as how it's looking from an export model. But internal demand, you've got 1.4 million people. You're running into winter. It's as cold as charity over there at the moment. And it's going to get colder over the next 2 to 3 months. So you need heating. You need demand, you need to keep the place warm. And there's the first part of it. As far as consumption, I think it'll be relatively strong. And we all understand, it's been very strategic buying from China as far as the likes of iron ore. Many of their commodities are at nearly record import levels. So, I don't buy the story that things are that tragically bad over there. It's pretty damn good, actually, when you're looking at the big picture. They need food, they need fuel, and they certainly need base metals, and they need plenty of energy.
Okay, all right. I'll come back to you about China again. But just to keep you, Peter, you mentioned the US dollar earlier, that it's weakening. It's a little bit. Is that, purely to do with the fact that now, or is it because people have accepted that rates are stabilizing, interest rates in the US, and so that's it. That's the new direction we're going in. And if anything, it's down with rates next year. So is the dollar picking up on that, or are there other factors that are?
I think there are other factors as well. I think it was probably cooked to the upside. You had very soft euro and pound. Yen was very much range bound. It was hovering around that 150, 151. It's back at high 148s at the moment. But the US dollar was cooked to the upside. It was very strong. The divergence between, from rate policy is the euro. We understand how the Fed came out of the blocks very quickly with rates. Eurozone was a little bit slower off the mark. And certainly the POMs, they didn't back down either. But now you're seeing both of those currencies strengthening a little bit further against the US dollar, and of course commodity currencies like our own. We're up 3.8% in the last week and a half, and so is the Kiwi. So I think everyone's been selling US dollars, Dyala, and that's where you have a close look. That's why I mentioned gold. Gold's at 2033. It was I'll have to look at the charts, but it's probably only 3 weeks ago. It's put on $100. So it's had a really nice rally, and that's, US dollar crushed and gold up. And that's been another key driver as far as markets.
I mean, Peter, sort of on that point partly, but on the point that Amar just made about dollar has reached its peak. Would you agree with that? I mean, obviously it's an FX thing, but I mean, would you agree that the economic situation and the debt and deficit situation in the US is finally going to start hitting home next year? And obviously
you would think so.
Currency.
Well, absolutely. I mean, you'd have to say it's very hard to put an argument or a counter argument against Omar's thoughts, or Omar's argument is quite simply because it's true. And when you're looking at
it's been true for many years. So I mean,
it has been true for many years, but we've had very cheap interest rates. We've also pumped in trillions of dollars over COVID, and you've now ratcheted rates up to 5%. So there's the other side of it, and that's where it's going to cost you so much more to service that debt. So bondholders and all of those impacts. How does the US get out? Well, it's got relatively strong GDP at the moment, but are things going to, see a big change in 24? I've just got some notes here. Third quarter GDP estimate for the US is going to run around about 5% annualized, up from 4.9. So we've got those figures being released this week. We've got other core inflation data being released this week. And with energy prices at these sort of levels, it's not a headwind. It's a very good sign for central bankers, because they want oil to be at $60 a barrel, not impacting inflation decisions or inflation rates. And no one wants to see, the continuation as far as rate policy going up. So if we were sitting here, Dyala, and oil was 110 or 120, I tell you what, it'd be a totally different world of what, from a rate policy standpoint and inflation. So there are many different moving parts to this. I'll just go back to when oil, and I'm just having a look here, it was at around about $1,830. It's put on $200 in just over a month and a half.
Gold.
Less than 2 months. Gold. Yeah. Pardon me, gold. Sorry, gold. Yeah. $200 in less than 2 months. So it's really ratcheted heavily.
Yeah, and I mean, one could argue that obviously the rate policy of the last year or more has also brought those. I mean, it has impacted oil prices, hasn't it? It is actually impacting demand. It's impacting, dollar-denominated debt and demand in those countries as well. So that's kind of all coming together there. Okay, there's our survey result, which is a bit dodgy, 50%, 50-50. That doesn't really tell us much. That's sometimes technical.
It tells you a lot, actually.
Yeah. What tells you that everyone's confused? What does it tell you?
Yes. Well, it tells you that there's no decisive viewpoint. That's what it tells you, and everyone has an opinion, and it tells me that from the marketplace, that proves that there are just as many buyers as sellers, or sellers as buyers, as far as whether they're bullish or bearish. That tells me a lot. So the market's going to the dynamics to drive the market. Yeah, I'd be interested to run that across X and put a poll out there for 24 hours and just see how many people vote. And
Peter, is there any sense from your point of view? I mean, you're not directly in that space of OPEC and what the countries are thinking, but do you think there will be an issue on this compliance with the large producers like Kuwait, UAE? I mean, Jamie just mentioned again, they're all increasing capacity and they do not want to be holding that back. How difficult is that going to make decisions for?
I think the greatest challenge, one of the greatest challenges, building on what Jamie said, as far as OPEC has always been concerned, and that is compliance, Dyala. And so everyone has a weakened balance sheet. Everyone wants to get back to every single country, every member wants to see a strong balance sheet. They want to see strong earnings. And the way around that is to, pump till there's no more left and get as high a price as possible. And that normally was their mantra. And it's going to be interesting to see how that all, I suppose, materializes over the next month or two. And whether you're going to see compliance angles or you're going to see, members do their normal way of doing business. this is all we're going to see a lot of interesting points into the market over the next 6 to 8 weeks as it digests this decision on the 30th of November, and then how it's implemented. And then the next part is execution.
Thanks very much to Omar, Peter, and Jamie for joining us this morning. Great. Have a good week ahead, everyone.
Thank you very much.
Thank you.
Bye.
Thank you.
Bye.
Bye-bye. Bye.